nobody puts in their heart and soul like Marissa and I do on our
Oh,
properties.
for sure.
There's
Yeah.
nobody like it's a lot. But I tell you what, there's nothing that no T's that aren't crossed, I's dotted. Her and I, she's in the books. I'm managing the properties, and I'm hiring the contractor. I'm not just gonna call, the highest or the quickest bid on replacing an air conditioning unit. Welcome back, everybody, to Ladders and Leverage. Today's episode, I am beyond excited because it really highlights the relationship side of real estate, where trust, experience, and having the conviction to really lean into deals that aren't perfect on paper. We're joined today by Shawna Phelan from SDC Capital. They're a private lending firm that specializes in short-term bridge funding in real estate projects. And SDC works with operators who specialize in repositioning assets, and they really navigate complex situations and solving problems that traditional lenders aren't really set up for. So Shawna really does bring a deep understanding from underwriting and risk and borrow alignment. I mean, we've done several deals together, and her expertise has really guided us and helped us with achieving our goals. So she's really been involved with finance on some very challenging assets, and this is really where the story, the operator, and the execution plan matter just as much as the numbers. So we're excited to have this episode with Shawna and go over everything that they do over at SDC Capital. So thanks for tuning in. We met through our first syndication,
Yes.
Yale Street,
Through an email that I received
right?
from a guy named Joe, because I get emails all the time
Yeah.
from different lenders. And we had bought Main Street, and then we went to get a loan from Chase, and they denied us based on the condition. So we learned that in escrow, and that was our first building we bought, just us and one other partner. So then when we went to buy Yale, I was like, okay, there's no way we're going to be able to get funding on this. We have to do hard money. And we did hard money on the first one with like a friend. And it was just like, I'm like, okay. So this gentleman, Joe, emails me and I said, hey, I want to buy this property. I want to do you have any hard money lenders or what have you? And that's how he introduced me to you.
Yeah. So
Yeah.
welcome to the show, Shawna.
Thank you for having me. I'm very excited to be on it.
Oh, we are too. We are too.
Yeah.
It's really ironic that, really like we were saying in the intro, just a phone call or an email or, can just really establish a relationship. So just for the listeners, Yale Street, we've talked about it on other episodes, but Marissa explains it very well. Why don't we tell them a little bit when we bought Yale Street, what that looked like?
We had hired Vinny as our coach, and we were looking for our first syndication, and we were looking out of state and trying to see like, oh, are we going to go out of state? And then I was like, why don't we buy something local? And I actually found it on the MLS. It had been on the MLS for like 90 days. It was, 1.2 million, a really small deal, randomly six tiny houses that were built in the 50s. 1 bedroom, 1 bath is what it said. And it looked horrible. I mean, it was total slumlord conditions. When we walked it, the sewer system was backing up out the back of it.
Yeah.
I mean, it was just no one had cared about this property ever, is what it looked like since the 50s. So I was like, there's no way we're going to be able to get financing on this one.
So I'm curious, Shawna, when we first met, and
Yeah.
that was our first intro, and you saw the conditions of the property, and it come across your desk, what were your initial thoughts? And, tell us a little bit about that.
So, I mean, when we look at a deal before we even go to the property, before we even get a quote, we're always doing some desktop underwriting before we even, give our quote just to make sure we can get to the terms that we're quoting. Our goal is not to retrade. So we looked at the property, had some concerns. I think at that time we probably had some information on the two of you, but hadn't met just from an email. So, your profile, we're like, oh, okay, they have some experience, they're putting their own skin in the game. It's multifamily. So about 60% of our loan portfolio is multifamily.
Oh, okay.
So that's kind of our area that we like the most. And so, yes, it was rough, but we were kind of open to, that's why people call us. And so, we thought this was a deal we wanted to do. We are primarily based in California, so that I think San Paulo at that point, maybe it still is, was not subject to rent control or limited rent control.
Yeah, it's still not.
No,
Just state guidelines.
Yeah, because the state came in after we bought it, I think, too. Because the state guidelines,
Yeah,
I feel like they came in
yeah, I think so.
right after we bought it, because we purchased that one in 2022.
Yeah.
So
we look at all that, and
Yeah.
so it looked good. So then let's, send the quote. As you know, we generally don't require appraisals. We inspect the properties ourselves. So we're very hands-on. So we also want to make sure that we're using our time and the borrower's time well. So, we're going to do that with the intention of getting the deal done if we can. So when we met at the property, I think when I met at the property, that was kind of what sealed the deal, to be honest with you. I mean, not that the property was in great shape, because it wasn't, but I think you both were there. You both kind of spent the time to walk through the units, kind of provide your vision. I think we talked about some ADUs that you were looking at down the road. I believe there was a contractor there as well.
Yep.
So it's like you had all hands on deck. So that's kind of, not that always works when we inspect a property, but when it does, it's like, okay, we know that they're spending the right time and effort in underwriting it and are going into this very, eyes wide open.
Yeah.
So I think, that helped a lot, and we could see the vision of what the property was going to look like. So I think sometimes, you do a property inspection and the borrower may not be there, or they just have the broker there. And not that means it's not a good deal, but I think it really makes a big difference, especially when you're dealing with a property that needs a lot of work, to know that this is going to be done, and the sponsors, the borrowers are really, have their, hands on all aspects of the deal and know what they're getting into.
Yeah.
Oh, yeah. I was so nervous. I remember that. I was like, she's coming to the property herself. I was like, oh, gosh.
Yeah.
We got to really, be on this. And it was, our second, little apartment building we had bought. So it was and we closed on it with our own money in the beginning. And then we funded it.
Right. And I think that also, the fact that you were willing to do that, was like, okay, they... we understand syndications, and we don't expect, borrowers to always put only their money into a deal. But I think when you're kind of learning the business and you're willing to put your money where your mouth is, and then over time grow and syndicate, we like that model, where, you're learning on your own dollars. And so I think that also just means a lot. There's no metric to evaluate that, but when we're talking internally as a committee, that plays into our decision making.
And that's a good point for people listening. And that wasn't even the game plan. I think it just happened to work out. We were both
that we were
going to
close it.
But no, that you and I were going to be at the property.
Yeah.
And then I happened to be with the contractor at the same time. But like you said, I've actually heard that from from a broker of mine, because when I inspect a property, I have a whole team that comes, and
all of our contractors
he said to me, he's like, I was just really impressed by, just how many people were coming in, and just the organization. So I think, first impressions mean a lot.
Yeah.
So that,
for sure. Yeah.
Yeah. So that's something I'm taking away from this.
And I would say, I mean, I work, we're a bridge lending firm, but maybe large institutions could be different. But I would think a lot of the bridge lending firms who are financing value add, they're like us, right? That first impression, and it probably speaks that probably you could say that across the board, but especially when you're dealing with value add strategies. Execution is key, and you want to make sure they have a good team.
Yeah. So how deep do you go on the borrower's background and experience and track record?
So, like I think I said, when we first do a quote, we always look at the property first because at the
Yeah.
end of the day, that's our collateral and we need
Yeah.
to be comfortable. So there are property types we don't lend on. We don't do hospitality, we don't do gas stations, as examples. So those are just quick no's. So we always look at the property. If we think we, like the property and are comfortable with it, then we get to the borrower, and the borrower, most of our lending now is on stable, like kind of stabilized to value add scenarios. We have done construction lending in the past, but currently are not doing that at this time. And that's a different evaluation when you come to like the borrower. There's a lot of execution risk, so we get much deeper into the borrower for those
Okay.
loans.
Yeah.
But for our typical deals, I mean, we do ask, loan application and credit and financial statements. Since interest rates have risen, we get a little bit more into liquidity reserves just
Yeah.
because we've seen borrowers kind of run out of reserves and kind of be stuck in a position. So we do want to see some reserves. We don't have set metrics, but we want to know there's liquidity or ability to access liquidity, whether it's through putting a loan on another property they own. They can solve problems with the assets that they have. But I would, we do, so we don't probably spend more time on the property, but the borrower matters. I mean, we do Google searches, we do LexisNexis.
Oh, really?
We do, yeah. So there's a lot of information we can find
Yeah.
out, and some of the information that we do find out is a little bit of just double checking. Like, we have borrowers and they have foreclosures from 20
Yeah.
years ago. LexisNexis shows us that. Our tax liens that they ultimately got paid, and
Yeah.
we can see that. You can't see that on a credit report. But some of the checking we're doing is like when you're answering questions on your loan application, have you ever had a foreclosure? Have you ever been a party to a lawsuit, or are you currently a party? If those don't align with the
Yeah.
information that we're seeing,
Totally.
then it starts to raise some flags for us. So
Yeah.
it's really a little bit of validating what we have
Yeah.
on the borrower, and most of the time it just confirms the things we know. But there are times where we find things that make us concerned because there's inconsistencies.
Yeah, and I think that's important because, like, for myself, I have a BK and a foreclosure from way long time ago when I was in my late 20s. But yeah, I mean, because basically I went and spent a bunch of money on rich dad, poor dad classes, and then the economy tanked.
Yeah.
And I'd only been 1 year out of college and was like, oh, okay, there goes the house that I bought, and there goes, and we kept the other house. But yeah. And then I'd put all my credit cards thinking like, oh yeah, I'm going to take these investing classes and become an investor. And then it was like, holy moly. And now I was making 6 figures and made $7,000 in 1 year.
Right.
I was in commercial
A
real
huge
estate then.
change.
Yeah, and it was crazy. And even with a degree from Pepperdine, I couldn't just run out and get a job.
Right.
There
Yeah.
was like nothing. It was, yeah. So, and that for me, because when I work with lenders, I tell them that up front, because you don't want to get into a situation where then they find that and are like, well, why didn't you tell me? And it's like, well, mind you, it was over like what now, like 15 years ago.
Right.
But yeah, because I had always heard, oh, if you ever have that, nobody will give you a loan. And it's like, no, they will, as long as you've proven now.
Right.
And luckily it was the Great Recession and everybody else in the
Right.
there was many other people.
Yes. Yeah. We
It
look
wasn't
back at
just me.
that time and we were like, okay, we know there was a lot going on.
Yes.
Anyone who's in real estate, there's a good chance they had foreclosures. It's
Yeah.
just, if that pattern continues till
Yep.
today, then there's a problem. If it was like a one-time thing, we understand that.
Yeah.
So it is important. I think just being honest, I understand like the hesitation for borrowers sometimes to do that because you're worried you're going to not get the loan. But,
Yeah.
I think for the most part, I mean, I think, most lenders, especially in the bridge space, are not quite that black and white,
Yeah.
because it's the nature of what
Yeah.
we do. And so just honesty is really the most important, and then it doesn't waste your time.
Well, and when you're an entrepreneur, and you're a young entrepreneur, and it's not like if you don't have like family to back you up, it's like, well, yeah, a lot of people had to short sale or what have you.
Yeah.
I mean, when I got into residential, I helped so many people through short sales and sold so many foreclosures because it was just going on across the board.
Yeah.
Yeah, it was crazy
I mean,
times.
your reputation is really collateral, and when a deal is distressed and numbers really only get you so far. So, your reputation is how you communicate, how you perform under pressure, and then also how you handle problems. So it's often all those things is what I imagine a lender gets from that no to a yes. All those things are important.
For sure, yeah, like, just being honest and open and putting it out there, and, there's times where you get halfway through the due diligence and you find that out and you're like, now
Yeah.
it then it puts other concerns, right? Like, then you
Mhm.
start thinking, "Well, what else do I not know?"
Yeah.
Yeah.
And so even though that might be the only one thing, it's just human nature to be, we don't know everything. LexisNexis isn't perfect. Credit
Yeah.
reports aren't perfect. So
Yeah.
and sometimes there's things that are happening in someone's life, a divorce, things that aren't on paper, right? They're
Yeah.
not public knowledge, but are happening that, can put pressure on a borrower in a
Yeah.
situation. And so, we don't know personal situations. So if you aren't honest from the get-go, then it does lead to the concern that there's more there that we may
Yeah.
need to figure out.
So, is there a situation where the numbers really made sense, but you guys decided not to move on the deal because of the sponsor?
There definitely has been. There's actually one recently, and so that one's easiest to recall.
Yeah.
I, we've been lending for 15 years. So we have a lot of war stories, and sometimes I feel like we should probably write some of them down because
Yeah.
they fade with time. But we were recently almost. I mean, actually, I think we had even issued loan docs just because sometimes in our process we do parallel process a little bit the underwriting with the loan docs just so that we can be timely in the closing. Doesn't necessarily mean we are closing, but we, are working through our underwriting as docs are being prepared. And this situation, it was a multifamily property in the city of Los Angeles, subject to rent control. So those are, in today's market, tricky because rent
Yeah.
control in LA is just getting more and more restrictive. And it was a cash flowing property. A lot of the units were close to market, so it looked good on paper, and we had done our inspection. The property was in reasonable shape. A couple troubled tenants, but we knew about them. We were refinancing a bank loan because the borrower wanted to take out more proceeds to finish an ADU and do some work to the property,
Oh, okay.
and then would refinance our loan with another bank loan.
Oh,
So
interesting.
it all looked good. The question we kept coming back to in the situation was their liquidity was really tight, and, that was at a loan amount lower than ours and an interest rate lower than our interest rate.
Yeah.
So it just kept raising the question of why are they not cash flowing from this property more than they are? And that was the primary asset. They had a couple other small, real estate properties. So we just couldn't get comfortable with that answer, and so, in LA, if rents aren't, at market, it's really tricky. You
Yeah.
really are stuck with those tenants, and we have had a situation where someone forged leases on a rent-controlled property at
Oh, yeah.
rent rates that were double. The leases said they were double than what the tenants were paying, and so we've
Wow.
gone through that and, know that happens
Oh
because
my
borrowers do
gosh.
get desperate, and so when things don't add up in this current
Yeah.
situation where maybe everything was still above board, we don't know, but, and they were having some late payments with their current loan, so things just don't add up, and there's times where, like, the the property we're comfortable with, our loan basis we're comfortable with, but we just don't understand the story. And once we get to that point, if and maybe there's a good answer, we just never got it. And so we just said, okay, well, we just don't get the
That is
story.
so crazy. I did not that literally would never cross my
Yeah.
mind that someone would forge leases to try and get a loan at a higher amount, and because it's like, well, you're gonna see it though in your P&L. How
Yeah.
does it you're like, "Oh, yeah, I've been collecting all this rent," and it's like, "Okay, well, where did you deposit it?"
And in this day and age, I mean, it's harder. Like, yes,
Yeah.
as a landlord, maybe, you have, tenant fraud happening, you have,
Yes.
borrower fraud. But I mean, with AI, I mean, forging leases anyone can do. You don't need AI, but like forging bank statements, a lot of things. So it's
Oh,
sometimes.
wow, so they're going, like, the full
Yeah, they
way.
didn't in that situation, but there are ways, that things can get,
Yeah.
all packaged very nicely and tell the story that wants to be told and isn't necessarily a story.
Oh, yeah.
So, we've gotten better and kind of ferreting that out and trying to double check. Or if we just don't we're not comfortable because we're not seeing that cash flow or something's not consistent, we're not willing to, you know, look past it, right? Like, I mean,
Yeah.
even if we like the loan and the property, it's just like we don't get it and we don't know what bodies are buried. So, we just
Yeah, better
deny.
to shy away.
Yeah.
Oh my gosh. I didn't
Um,
even think about that.
have you guys ever had to take back a property or foreclose a property?
We have not, so we look at this. We have closed on, I think it's like 700 loans in our 15-year
Wow.
history, and we've foreclosed on, I think it's 7 properties. So
Oh,
not a ton. I mean, there's kind of filing the notice of default when someone's late.
Yeah.
That doesn't mean you have actually
Yeah.
foreclosed, and then there's actually going to the foreclosure sale. So we have foreclosed, I think it's 7 properties. One of them was the tenant, the borrower who committed lease fraud and
Yeah.
forged the leases because it ultimately he just was trying to buy time and eventually time ran out. So, and usually, the few situations are kind of all different, and it's usually more. It actually comes down to, I would say a lot of it comes down to the borrower. The property maybe is not performing, but the borrower is just, not a good borrower. They're struggling in other ways, and so
Yeah.
that's what
yeah, they're
ultimately.
like using the cash from the building to support other things and not just supporting the building, probably.
Right.
Yeah. Yeah. I could
But
see
I
that.
will say, so even with that, we've, fortunately through those processes, we've been able to recover, at least our principal. Maybe there's been a small gain, but that's not our strategy. We don't want to
Right.
own the property. I mean, it takes time to take control, manage it, put it back on the market. So it rarely leads to that, but usually, when we get to that point, just borrowers they can't stop the foreclosure. They have no means to
Yeah.
bring the
Yeah.
loan current
Yeah.
or get out of that loan.
Who's your primary client today? Who do you guys usually work with? And
I mean, like if it's like type, I mean, I would say like about half of our business is direct to borrower. Like, we have worked with you all, directly on the most recent transactions. About half of our business comes through brokers. So,
Oh, okay.
yeah. So, we do a lot of, we've been in business for a while, 15 years. We do email blasts. We do paid search. We have our website. We go to conferences. So we have a lot of relationships we built through
Yeah.
all those means.
Oh,
But
yeah. I referred Nick Henry, one of the guys we had on this podcast who's in Ventura County. He's a big
okay.
multifamily guy. And I told him about you guys because I was like, oh, yeah, they're great.
Yeah. No. And
Um,
that, I mean, the
it's word of mouth.
word of mouth. And, sometimes they'll call and we'll talk about a deal and, it doesn't pan out. But, usually, I mean, I think kind of what your experience was is the email communication, the
Yeah.
outreach we do, it's really kind of, we recognize, I think, over doing this over time, it's a little bit of just, we send them out and if you hit the audience at the right time, you happen to be under
Yeah.
contract, your lender just told
Yeah.
you that they denied you, something's happened and now you're 2 weeks away from closing and you get the email. Like some of that's just kind of being lucky on timing, right? And then
Yeah.
you hit them at the right time and they need you and then, they're responding because they know you can close quickly. So, all those means, some other, we have one borrower that we work with directly that we met at a conference like 6 years ago, I think it was about, and he's very active in LA, multifamily value add. And over that 6-year period, I think we financed like $70 million of his transactions
Wow.
for, him. He's, has like a fund and syndicates his transactions. But, that relationship really has grown and been successful. And I'd like to think, for both of us,
Yeah.
and so we have a good working relationship. We can get typically to the property when they're doing their inspections, so they don't have to do multiple inspections,
Right.
theirs plus ours. And so we have a nice system in place and can, finance, majority of their transactions. We would love to have, 20 of those borrowers,
Yeah.
Yeah.
because it is a great, I think, synergy to be able
Yeah.
to do that. But, not everyone's buying, 10 deals, 10
Yeah.
transactions a year, and we recognize that.
Yeah.
But so that there's a lot of one-time transactions that, maybe the borrower just needs us for that particular deal, and that's, the only value we really can provide to them, and other situations where we can create that kind of repeat relationship.
So, question about him. He's doing value add in LA. Is he buying mostly smaller buildings and adding ADUs or like, because I feel like that's a harder play since you can't do the No fault
Yeah.
Renovation.
eviction.
Well, so
substantial remodel eviction.
it's a good point, but they are not in the city of LA. So it's LA
like
County.
LA County. That's
And
okay.
so they're basically focused on the areas in which, they
like
can.
Long Beach, Santa Clarita,
Right.
like all,
Yeah.
Okay, because I was
Bell.
like,
Yeah.
oh, so
Yeah.
they're down there.
Yeah. So Southgate, Cudahy. So very specific on certain markets where they can
Yes.
execute their plan.
Yes.
Yeah. So
so similar to us, but down there on the other side. I showed him because I went to Cal State Long Beach when I first went to college. And I showed him Long Beach and I was like, we drove down there on a Friday and I'm like, this normally takes 45 minutes and it's taking us 2 hours. And I was like, this is such a, like, if you don't live down there.
Yeah, it's so hard.
Holy moly. I was like, I think I'd rather go up the other way to like San Ynez and like even go to San Luis Obispo.
Yeah.
Where like, it's going to take you 3 hours, but it's going to take you 3 hours.
Right. Yeah. And it
Driving
won't
through
be a
LA is
painful
like-
drive that, it could take 5 hours if there's really terrible traffic. So, and I think that's something as like we see with different borrowers we work with that kind of thinking about your geographic footprint, is that, it is hard in California unless you have resources at different locations to manage a broader geographic footprint. And the hard part is sometimes you have to expand a little bit because opportunities come in different areas.
Yeah.
And so you might need to broaden that footprint. You can't keep it just in your backyard, but it does become challenging. I know you manage your own properties. So that's, which I think is actually great. And that was another thing I think about the two of you that, not everyone has the means or the ability to manage their own properties to do it well. But a lot of times we see people who outsource management and it can be done well. It just, you really
have to be on them.
You have to be on them. And a lot of times if you're not, it doesn't, you're not going to be achieving your goals and you're going to have a lot of issues, or you're going to think everything's fine until you realize it's not. And so the fact that you manage your own properties was like another part that we're like, okay, this is a strategy that we like, and, we know that they're, they know what's happening. If there's a bad tenant or something going on, they're not finding out about it 9 months down the road when there's a lawsuit or the police are involved, or something like that. So,
which is so funny because like conventional lenders don't want you managing your property. I mean, the only reason we're allowed to now is because we created a full property management company.
Right.
Because I remember when we were buying the first building with Chase and I was like, I'm going to manage. I've been in residential and been licensed for, 17 years. And it was like, no.
Yeah.
And I'm like, do you know how many leases I've done? Like, I'm going to care more than some property management company over my little 7 unit. And it was just like, no, you have to. Yeah. So until we actually opened and created our own, I had a friend who would write my property management contracts for me.
Yeah. I mean, I think it's maybe I don't understand it necessarily, and that wouldn't be our logic. But from a bigger institutional perspective, you're like, you can kind of say, okay, at least this management company, this is what they do, right? And so they, theory, know kind of the rules. But I still think that especially if you're building a portfolio of real estate, self-management doesn't have to be, but some component of it should be, or you really need to be very you have to monitor the managers you're working with. And if you're really thinking they're just doing it, it's all going well, I mean, it's possible, but it's probably not.
We're both all no. We're like, as manager owners, we're like, no.
All right. I have to tell the story from yesterday. And by the way, managing your own properties
is really fun.
Hell, okay?
It's so fun.
It is hell. It is a lot.
It's a lot.
So I get why people outsource. But okay, so I was in Oxnard and there was a rental by our building. So I call and I'm just curious. I'm asking, I want to know what the rents are going for. I want to stay up to date.
Doing a little market survey.
Yeah. So I call and, hey, I'm interested in your property over here, on this street. And she's like, I'm actually at lunch right now. I'm taking lunch. Can I call you back? Oh, yeah, no problem. So she calls me back, an hour later. And so I'm asking about the property. And I go, are they renovated units? She's like, what do you mean? I'm like, are they remodeled? And she's like, well, yeah. And then I said, oh, okay. And I said, well, what kind of counters do you guys have? And I was on speaker, and some guy in the background goes, he's asking too many questions. He goes, who is this? I go, this is Danny. He's like, what questions do you have?
This is wonderful sales.
Right. Yeah.
Wow.
And I was like, I'm good, thank you. So that's the type of thing is
Yeah.
like
Yeah.
you're saying, nobody puts in their heart and soul like Marissa and I do on our
Oh,
properties.
for sure.
There's
Yeah.
nobody like it's a lot. But I tell you what, there's nothing no T's that aren't crossed, I's dotted. Her and I, she's in the books. I'm managing the properties, and I'm hiring the contractor. I'm not just gonna call, the highest or the quickest bid on replacing an air conditioning unit. Like, I have the relationships. I'm grinding my guys every day. Like, that's just how it is. But no one's gonna put that same effort that you do
No.
on your own
No.
property.
No.
So, and that's
It's a
probably why
lot.
you're like, yeah, I like these guys. Like, they're gonna,
Yeah, they're vested.
Yeah.
They're willing. I mean, and
Yeah.
it's not easy. And I think our firm owns some real estate as well, and we've self-managed over the time I've been there. I think almost majority of the years that we've had property.
yeah,
It's on. It's and I think internally it's a challenge for the those who are doing that, but it's just we've tried outsourcing management on different things and just never been successful.
see, yeah,
So
Yeah.
Yeah.
See, even though, so my mom's our broker, and
Oh.
she does like all the rent reconciliation and all the stuff. And so, and then we have another employee too. And then we have our on-site managers, right? And, nothing's ever perfect. And that's like, and I just say to him, I'm like, another off-site manager, like we just bought this building, 36 units in Thousand Oaks. The on-site manager was collecting the rents, depositing them, doing all the leases, pre-qualifying the tenants, any maintenance she would schedule. And then they were paying 5% to an off-site property management company. And I'm like, what are they doing?
yeah.
Like literally,
There's
like
not much
nothing-
else.
like
yeah.
what?
They're just recording the transactions.
Yeah.
Give
And
me
they
the
didn't
Yeah.
even
record.
record it
Money's going in,
correctly.
yeah.
I had to like go back to them because this on-site manager is like, no, they paid their rent. Because I'm like, hey, these people supposedly didn't pay their rent for November. Then there was another tenant who had gotten some charity help for rent for
Right.
December, wasn't recorded anywhere. And she had it recorded on her ledgers. But the property management company who is giving us then the rent rolls, right, and giving escrow the rent rolls had never recorded. And I'm like, really? What are you people doing? It is
And
so, and you pay 5%.
right. And I think
of
that
your
is
gross
like
rents.
either you're really on it because you have to compensate, and then that is the other part of the equation. Then you start asking, why are we paying this? Or
Yeah.
or you're paying it and kind of not aware of what's really occurring.
Yeah, I was like, wow, this is insane that these people just sat back and they're like, we're getting our 5%, and this on-site manager is doing it all.
Yeah.
Jeez, it's wild.
Yeah.
So, back to kind of you guys, what's your guys' typical loan size, and what's the max loan amount, SDC will consider?
So currently our loan sizes range from like 250,000 on the low end up to 5 million on the high end. And we lend in California. We lend on residential and commercial properties, the kind of the major food groups of commercial, so multifamily, retail, office, industrial. We don't do hospitality, gas stations, like special purpose assets. We don't lend on those. And we do junior financing, which is a little unique that we do second liens. So a lot of some lenders who are even doing bridge loans are only doing like first position
Yeah.
loans. So we will fund liens in second position on various property types.
Up to what LTV? To get a second?
Usually we're 65 is kind of 65 in first, and in second is kind of where we cap out generally on value add properties. On a purchase will generally go up to 75%
Okay.
of purchase as is value, because we expect that value will be created, so our loan to
Mhm.
value will go down over time. We also expect that then we want the borrowers to be able to exit our loan. So
Yeah.
if you're executing a strategy and you get down to 65% at completion, then you can probably exit our loan. If you're at 75, there's not that many exits other than a sale. So we don't like that being the only exit on a property.
Interesting.
Yeah.
But, I think one of the things that we talked about a little bit earlier, we have a fund now. So we
Oh,
launched
yeah.
at the beginning of this year what's a debt fund. We typically had done our lending through individual loans. So we had investors coming into each loan, depending on what the scenario was. Now we have a fund that we've raised. So we have a pool of capital that we're lending to our borrowers. And we have parameters that we can lend. So we have the property types and loan to value criteria that we have to meet per our legal documents. With the fund, our goal will allow us to grow, and so it's fund sizes as our fund grows. We hope we can then be involved in larger transactions. I think there were a few transactions, maybe timing wise, you
Yeah.
had come to me. And I said, I just don't think we can fund a loan of that size,
Yeah.
and so, we don't necessarily want to compete necessarily in, a $30 million loan, but we would, like to grow our loan sizes over time as our fund grows. And it's a better model now that investors have a diversification of a loan portfolio. So even if our loan grows to, 8 million and it's 10% of the portfolio or 7% of the portfolio, it's still a small fraction.
Right.
So that's kind of what we're looking to achieve.
Okay, so I got to ask a question on the side of an investor who invests in a debt fund. What does that look like for them? So if I say what's the minimum someone has to put with you, and then what are they
Returns.
what are they looking at getting?
So in our fund, our minimum is 100,000.
Okay.
And the returns for this year kind of have averaged around 8.5% plus or minus. So the yield in our fund isn't fixed. There's no preferred return, no guaranteed return. So as interest rates move up or down, the yield of our fund kind of moves with the interest rate environment. Now these are short-term interest rates because our loans are short-term. So, this year is 8.5%. Next year, hard to say, for instance, I think rates have softened a bit. So, maybe the rate will be, in the low 8s next year. But yeah, I think for, from our perspective, for having, consistent cash flow because we pay monthly dividends.
That's what my next question was gonna be, like, how often? So you're paying monthly. That's kind of cool.
So that is a nice.
We pay quarterly, so
Right. And I think as a owner, real estate,
yeah.
syndication paying monthly is probably not practical,
Yeah.
Yeah.
Because
So-
something comes up and then you're like, oh, I kind of need the funds from last month.
right. Wouldn't
Yeah.
maybe be a good choice. But for what we do, because,
Yeah.
borrowers are paying monthly, we're getting cash flow monthly. So it's kind of set up for to be able to do monthly distributions. So it's, we have a lot of our investors, many who we've worked with for over 10 years that we're doing the individual loans have come into the fund now. And I think, it's been a good transition for us. We are happy that we've been able to achieve this, and now I think it allows us to provide different services to our borrowers than we could. We're now able to consider credit lines for the borrowers where maybe you're drawing some amount today, and then when you get to the ADUs or you have another part of your strategy, you can then draw the additional proceeds as you hit those
Oh,
milestones.
interesting.
Where
Okay.
it was always tricky when you have a loan that you're working with an investor to say, to your investor, it's $1 million loan. They're going to draw 600,000 today, and then 400,000 maybe in 6 to 9 months. Anyone in that loan has to be able to have that money when you're ready to draw that
Yeah.
that amount. So no one really wants to have to
Hold
sit
it.
on that money waiting for you to draw. Now that we have a fund, we kind of have a credit line for the fund. We have capital coming into the fund, so we have a lot more control to be able to provide a credit line, some flexible terms to borrowers that doesn't impact our ability to hit our returns for our investors.
Oh, that's
And so
awesome.
people can invest through their IRA
Correct.
into the fund.
Yeah.
And then the cash flow is just going back into their IRA.
Right. So
That's kind of a cool.
Yeah. So I know,
That's really cool.
you had the individual from the IRA company on.
Yeah.
So yeah, it is a great vehicle, and it works out nice because for many, especially with your IRA, you're generally not looking to tap that money soon. So you can just you could either take monthly distributions or you can just let it sit and reinvest and then grow that position over time. So
How long do they have to keep their money with you?
So we just have a 3-month lockup.
Oh, wow.
So it's very short. We hope investors stay longer.
Yeah.
We don't want someone coming in and then
Yeah.
4 months out wanting to withdraw it. But that's what we do, which is, way different than what you all do is just because we have loans that are 12, 18 months.
Yeah.
I mean, we're getting, $3 to $5 million of payoffs every single month. So
Right.
if an investor says, hey, I need my $500,000 out, in January, we have some visibility because we, look at our loan payoffs and say, oh, we have 2 million paying off. So when those pay off, we can redeem your $500,000. So we just have, it's not meant to be a money market. You're not supposed to be coming in and out. We don't have, then
Right.
the accounting and the tracking gets a little tricky, but it is really kind of meant to be somewhat of a liquid investment,
Yeah.
where you can come in and out as you need to.
Yeah, because we get the objection, especially from people probably in their later 70s to early 80s who are like, oh, I don't want to lock up for 5 years.
Yeah.
But they want something to diversify their portfolio, so they're interested. But then they decide, I don't know if I'm going to be here in 5 years. I'm 82,
Right,
We
right.
should start sending them
To
to you.
Shawna, yeah.
We can. 'Cause
Yeah.
I get that all the time.
We do.
They're
Okay.
like,
A
dude,
lot.
I just want cash flow.
That's why I was asking. 'Cause
Yeah.
a lot of people just want, and then I have a lot of people who just want cash flow, like because our cash flow doesn't even start for 2 years.
Yeah.
Right.
You have
to
you're sitting
stabilize
there.
the asset and
Yeah.
get the bank
Yeah.
loan in place before you can
So-
do that.
It's a family business, right?
We call it a family office. So the founding principal of our firm, our name is SDC Capital, and so S is Silverberg. Warren Silverberg is the founding principal. He's a licensed general contractor for 40 years, real estate broker. Has built, I think it's like over 500 homes in LA in his career. Some small commercial apartment buildings, retail properties, and so it the money that we're investing is mostly coming from him, and so we started the business within the company originally in 2009, 10 after the great financial crisis.
Yeah.
Never had been a lender previously. He's always been a developer, investor in real estate, never a lender, but got to a point where, we were fortunate that we were sitting on cash because we had entitled and sold properties before the market corrected. So that was great. And so originally we were trying to invest in more, commercial residential properties, but the market hit and changed.
Yeah.
But then, you think, oh, well, great, there's all these great buying opportunities. But it took a while for, I think, sellers to come to the realization that value is no longer, it's now 40% less than what it was 2 years ago. So we were just like, well, maybe we should lend the money and see, capital is needed in the market. And, we can underwrite real estate. Why don't we just lend it out? So originally we kind of did this thinking we'll do it for a few years and then just go back to real estate investing. And then it was like, oh, this is a good business. And the bridge lending market has really evolved in this time. And maybe you guys have seen it too with different partners you've worked with. But I mean, it's really, when we started, it was definitely, kind of very still fragmented, but very fragmented. I mean, rates were, 12, 13%. I mean, you kind of felt like you could charge almost whatever. Like there just didn't feel like that. I mean, there was competition, but it's just limited.
Because the credit crisis, I mean, there was just all the banks were seizing up and not lending at all. So you had to use private money.
Yeah. And then I don't think the private lending market wasn't as established. So, like us, players came in just like, oh, okay, let's lend and, figure it out. And so over, I don't know, the past, decade, it's now become there's more institutions participating. It's, I would say, I don't know numbers exact, but I mean, I would think the market's probably, as a bridge lending market in the U.S. is probably like tripled or, quadrupled. I mean, it's just really grown, and it's just become a little bit of the part of the financing options that are available to borrowers.
Yeah.
I think before you thought, oh, you have to be desperate if you're going to a
Right.
private
It's
lender.
such a bad stigma too.
It does.
Like, oh,
It
hard
does.
money? Oh my God.
Yeah.
Right. Like there
No.
must be an issue with you
Yeah.
that you're going through.
Yes.
And I think it's got to a point where people accept it and almost like just that's what you do, especially when you need it quick or you have a value add or something that's a little bit trickier. So I think, that kind of helped us to stay in the market. We kind of, grew with it and found our niche. I mean, when we first got in, a lot of the fix and flip single
Oh,
family
yeah.
lending, we were
Oh,
somewhat active in that. And then the institutions really came into that space and started offering, 80, 90% loan to value, 100% of rehab,
yeah,
at 8 or 9%. We were like, oh gosh, I don't know.
Yeah.
I'm not sure we could be competitive with this.
Yeah.
So, we just kind of had to find our niche over time, and it's changed, and it will continue to change as markets
Yeah.
change. But we've really liked the multifamily market.
yeah.
That's so cool. I
What?
was curious on that. I was
Yeah.
curious how you like. I was like 15 years ago. I'm like, that's when everything was going
Yeah.
down, and most people were like, "What is happening?"
Yeah.
But huge opportunity for.
Yeah.
Yeah, it was an opportunity. It was also a little like, I don't know, do I want to be
Yeah. Do
this-
I want to be the one holding the note when
Yeah.
everyone around foreclosing?
Right.
Yeah.
And it just had a bad, I think, more of a reputation too. And I was like, I don't want to be in a space
Yeah.
where you feel there's a sense of, being a predator in it. Like, and
Oh,
I think I didn't
'cause
like
the
that
whole
concept.
subprime,
Yeah,
you're like you don't want to be like you're taking
I'm
advantage.
taking advantage
Yeah.
of
Yeah, I could
borrowers,
see that.
and like you're just charging
Yes.
whatever you can charge. Because I don't think that's a sustainable. Like, I mean, maybe
No.
it works and exists, and you need some of that in some part of a market, but that's not the
Yeah.
market I'd want to participate in the long
Yeah.
term.
Right. I could see that.
So, from a high level, what does the current lending environment look like, and what should borrowers realistically expect today for like rates and then leverage?
So, I think the lending markets, and I think you probably know this better than I in some way because I get a little bit siloed in my world of our bridge lending market. But I mean, from my perspective, I think the market's functioning better on the lending side.
Yeah.
I think what we experienced in 22 and 23 with rates moving significantly, we did a lot of extensions on our loans because borrowers, either hadn't achieved their plan or the rates meant that their exit couldn't be underwritten at that point or whatever. They were waiting for rates to maybe come down. So, and banks were just sidelined. I mean, banks were requiring, and I'm sure
Yeah.
ridiculous amount of deposits to get a loan at 50 or 60% loan to value. And you're like, does this make sense? Like,
Yeah.
this is like a no brainer. And you want me to give you $1 million of my
Yeah.
assets? Like,
Yeah.
I don't understand. So that market was tricky, and I think it wasn't obviously operating well. I think now banks are kind of worked through the interest rate change and kind of recalibrated to the current market that we're in.
Yeah.
And so I think, banks are more active. It's hard for me to say if they're like kind of where they were, during the pandemic or pre-pandemic, but I think they're still a little more conservative because I think there's still a lot of headwinds in the market. So,
Yeah.
it's hard to
agree.
be just lending aggressively in this
Yeah.
environment. But so I think overall, like the market's probably functioning well, and there's a lot of different options for borrowers, whether it's conventional or
Yeah.
bridge type financing. Loan to values, I would say on the bridge loans, probably 65-75% loan to values is probably typical.
Yeah. That's what we're getting. We're getting like 70% loan to
Okay.
value. And
Yeah.
then plus the draw lines for construction.
Right.
But yeah, the initial purchase loan is usually 70%.
Do you
Yeah.
guys do that? Like the draw lines and all that now that you have the fund?
Yeah, so that's kind of what we're trying to kind of
Okay.
create some opportunities to be able to have some we actually did a few deals so far where like we had some borrowers that had ADU plans approved. We were ready the lender in first position when they bought the property. Now they're ready to proceed with ADUs. So then we did a second on their properties so that then they had funds for their ADU.
Oh, see,
and it was
Acacia.
structured like
We use them for Acacia because Acacia was one that was
We
red
use-
tagged by the city.
Yes.
It was a little 5-unit
Yes,
in
yeah.
Santa Paula. And then we got the ADUs approved, but for some reason they were going to be really expensive.
Yeah.
Like way higher price per square foot than we were used to building. But we didn't have like the cash on hand for it because it's also harder when it's small.
yeah.
There's really not a very good market for like the bigger ones. Like, so as long as you're doing a purchase loan over 5 million, it's easier to get construction draw lines.
Okay.
Whereas like for like you guys will be in a niche market if you're willing to do like $1 million or something around there purchase loan, and then even have an ADU construction draw line
Yeah.
is huge because you can't really
Can't get that.
Mm-mm.
Yeah, that's interesting.
No,
Yeah.
not sub 5 million is really hard to get loans, and I didn't realize that.
Yeah.
Yeah, it's much more difficult.
Interesting. Well, and I think on the ADU, like we historically, but that may change. Like we've ADUs, in California, I think take 6 to 9 months maybe before you have plans approved. Maybe
Yeah.
you guys have
Yeah.
had a
Yeah, no, I
faster
think
experience.
that's about
No, I'm a year and one, but usually
Okay.
it's 6 to 9.
Okay.
yeah.
Yeah.
So, so with that, we've always balanced, and now it's a different trade-off, but it's like, okay, well, and you don't know for sure exactly what's going to get approved. I mean, you have an idea or what should get approved, but that it's kind of hard to underwrite, milestones or whatever the way that
Yeah.
mechanism is going to work once you get the ADUs
Yeah.
in process. So,
Yeah.
so a couple options for borrowers is one, if you're getting a loan, I would say, especially when it comes to multifamily or commercial, like if you can with the lender, if you plan to do ADUs and you're not getting that financing from the get-go, is if you can have the lender who you're getting the loan from in first position at least allow you to get a second, because a
Yeah.
lot of commercial loans don't allow junior financing.
Yes.
So, I mean, not saying that every lender is going to agree, but
Yeah.
like that sometimes is a trick, because even you like to keep that, whether you got maybe a conventional loan or a term on a loan, you
Right.
don't like to keep that in place and not pay
Yes.
points and fees on refinancing the whole thing. So one, if you have a kind of a two-part strategy, see if you can get them to allow subordinate financing, or two, as we kind of develop our products in this space, maybe, finding a lender who can have that money available to you so that you have that, even though it's going to happen more, towards the end of the first year,
Yeah.
and not have to refinance at that point in time.
Yeah.
So
Yeah.
No, that's good. That's good advice. I know you touched on it a little bit, but does SDC or its principals invest in their own real estate? And then if they do, how does that perspective influence your like lending decisions?
we're not actively buying properties
Okay.
currently. So, but we do own and manage for the principal the properties he owns currently. So,
What are they?
we own 5 or 6 multifamily properties in LA,
Okay.
and we also own a couple of commercial and retail office properties in LA. We have a building, a couple buildings. Well, one building out of state, and then we're also, participants in a multifamily strategy out of state in Colorado and New Mexico. So but it's not an active part of our business. Kind of our business has really been focused on the lending side
Yeah.
currently, but I think having owned and managed the properties that we do, I think we have, pretty good understanding. I mean,
Yeah.
one in our office, and we're not a big team. I think it's 8 of us in
Oh,
the
is it 8?
office. Yeah. So 8 of us in the office, and then we have some offshore resources too that help with some of the accounting processing loan processing. Um, but, 2 people in our office, are very experienced in construction. So, like, even though we're not doing really a lot of ground up, we have done it in the past, and
Yeah.
like ADU financing and plans and
Yeah.
permits and the city process. So we have that expertise. We have a couple people in the office that are doing management of multifamily and commercial properties. So, we know, kind of a little bit of what that
Yeah.
takes and what's involved with that. So, it can be as simple as someone buying a commercial property and not, or even, a multifamily, a 5,000 or some small budget for renovating units. And, we kind of like that just it doesn't seem possible. Like, educate
Yeah.
us on how you're doing that, because,
Yeah.
we need to understand that. Or maybe you don't understand what's involved with renovating an apartment building. So,
Yeah.
I think, or commercial property, knowing that typically you're paying, tenant improvements and leasing commissions. So if you're not putting that into your budget, it's going to be difficult for you to lease that vacant space. And so I think that just helps us kind of vet a borrower's strategy
For
and
sure.
see how, well informed and, thoughtful they are in
Yeah.
their approach.
And educated on it. Because, yeah, I mean, it's just so important. The underwriting is the most important part, and I try to underwrite really conservative on things so that in case there's issues, I have padding for it,
Yeah.
and especially with the way interest rates have been. Luckily we started when the interest rates were already starting to go up. So, but I was always like, wait, syndicators bought buildings and thought we're at 2.25%, 3%, and you were going to just refinance at 3.5%.
Yeah.
Like, how would you even come to, like, you have to have put in, but I guess there were several who didn't.
Yeah.
Yeah, it
You know,
is
I would have been
shocking.
yeah,
That,
I would have
yeah,
been
then,
underwriting at like 5%. I'm like, oh, okay, probably could go to 5. Like, that's probably my worst case, you know?
right.
And then they probably would have been fine if they had at least even put that. But
Especially when you have other people's money involved, because,
yes.
it's different if you're needing to put capital in. And I mean, that's not great, even if it's your own property, but really tricky when you have investors and you need to
Yes.
raise money
Yeah.
from them.
Yes.
No, experience is huge for deals. I mean, we all
Yeah.
understand that. And when you've been through enough projects and, problems, don't feel like emergencies. Marissa's much better at that than I am.
I'm more emotionally
Yeah,
detached.
but they
It's
feel
from years of dealing in residential where it's the most emotional purchases ever.
Right.
Yeah.
Someone has to stay calm.
Yeah. Right.
Yeah.
And,
It's
and I think that gives lenders confidence because they know you won't freeze when, something goes
Yeah.
sideways.
Yeah.
You've been through it and been in the trenches and all that,
right. You won't go dark.
Yeah.
I mean, that's the thing. I mean, part of that, we've had borrowers sometimes that just, they don't make a payment and we call them, right? And maybe there's something happening on the property, tenant's
Yeah.
not paying, or
Yeah.
there's a problem, but it's like, well, at least just tell us what's happening,
Yeah.
and
Yeah.
maybe there's a reason, like, and then, maybe we'll say, okay, let's, when you get to this point, get the, that tenant pays, and we'll wait 30 days, or there's something we can do to help
Well, and
solve that problem.
and I think, it's interesting, and I guess maybe because I negotiated so many short sales when I first went into residential in 2010 through 2014. I mean, that was my primary business. And so I think like with Danny, I'll always be like, well, the lender doesn't want the property back. So if something crazy happened, right, and interest rates skyrocketed or something, like as long as you communicate,
Yes.
it's kind of the same with my tenants. As long as you communicate why you're not paying rent, and, there's a plan that we can put in place and you can get back on track, fine. But if you don't communicate and just are like deer in headlights
Yeah.
and, oh, this is just somehow whatever. Yeah. Like no one's going to want to work with you.
Yeah, and it's shocking. Yeah, not many, but it's always, there's always a handful that just, you don't return phone calls. You get to the point. I mean, we're sending certified letters, and you're
Yep.
like, and then you find out at some point when they do call you back, well, this is the issue, and it's like,
Yeah.
why are you not just telling us this?
Communicate.
I mean, we may not have answers for everything, but like, there's usually no downside to just being
Yeah.
forthcoming
Yeah.
with what you're dealing with, and
Yeah.
letting at least you can collaborate and see if there's a
Yeah.
solution. So.
Yeah, exactly. Like if you need an extension or you need like, cause that's, yeah, I just feel like people, we talk about this cause Danny is more harder for him to detach. But I said, but you can run into a burning building and have no problem getting on a roof and opening the roof when fire's below you. And that doesn't stress you out. And he's like, no. I'm like, I would never.
Right. Yeah. Like,
Or a car accident and someone's all mangled and stuff. And that like you're
Right.
just like, whatever, for me, that is horrifying.
right. That's where you just want to walk away and be like, I don't want to have to deal with that,
Yeah,
like,
yeah.
but
Yeah.
Yeah.
Well, we're going to finish with our final 5, but I'll have to say this is one of my favorite episodes. You're
Yeah,
Oh,
it's
thank
really
you.
informative.
yeah,
It's
and I
great.
think our listeners will get a lot of value from it. Yeah.
Well, and it's just interesting
It totally
to
is.
see the perspective of a bridge lender.
Yeah.
Because, we haven't had anyone on who's a bridge lender. We've had brokers who deal with bridge lenders,
Right.
but not the actual people lending the money and like what their mindset is for lending money. And I think that's so important for people who are going to invest in real estate because you do residential all the way through to multifamily. So to know like, oh, okay, so that's what they're looking for. Okay, maybe my credit's not perfect. And maybe you had a hiccup back in the day. But as long as you can provide, showing, hey, that was this, isolated incident.
Right.
And this is what I've done moving forward.
Yeah.
So I think that's really important.
Yeah. Well, great. Well, and I've enjoyed, I mean, it's been a great partnership with you two,
Yeah.
and working with you, and, seeing what you've accomplished. And, I think, I think just seeing the evolution of your deals, and I know you are still very active and
Yeah.
looking
Yeah.
and acquiring. And that's the type of relationship we like to build,
Yeah.
and so we really strive to provide value in
Yes.
what we do. I mean, we know we're a lender, and there's, we're not
Yeah.
operators, but, to the extent we can make your process easier in some
Yeah.
Oh,
way,
you guys are by
Oh,
far
you
the
guys are great.
easiest.
Yeah. No, you guys are great.
I'm always like, if we can use them, I want to use them.
Yeah.
Okay.
No, you guys do a good job.
You guys are awesome.
It was funny. I remember I was at Surfside and Shawna, I'm like, I saw someone drive by. She was in her, I don't know, SUV Cadillac or something. And I'm like, that's not a normal car around here. And it was, she was checking in on the property and I was over there doing something.
Yeah, it was funny because I was driving away and I'm like, oh, Danny's calling me. He must
Yeah.
know I was
Yeah.
here.
I'm like,
He saw me.
so you do check on the property.
Right.
Yeah.
I was like, well, yeah, I'm in the area.
Yeah.
But like, that was one. Sometimes I'm concerned, but that was not one I was concerned. I was like, oh, I'm sure, because it was like, that was an incredible deal. But
Oh my gosh.
That was so
I
random.
wish they were all that.
Why can't we just find random, vacant, remodeled 15-unit buildings every year?
In beautiful places.
Oh
you
my
keep
gosh.
at it enough, it will happen
We'll
again.
find
Yeah,
it.
10-minute walks to the beach.
Yeah.
Oh my gosh. I was like, this is the first building I want to move in.
Yeah.
Yeah.
We were actually thinking about keeping one for like Airbnb.
Yeah.
And like, our mother-in-law or whoever can go there in the summer. But
yeah. Investors were like, we could just rotate whoever invests in the deal.
Right.
You want to go spend the weekend in Port Wainimi?
Yeah.
Yeah.
All right. Final five. What is one thing most investors misunderstand about private lending?
I would say either we get a lot of inbound calls. One, we get investors probably newer to it that, like, oh, will you do 100% financing? I think that might be going away, or maybe we just don't get those calls as much as we used to. But, that was, for whatever reason, I think there was a misconception out there that, bridge lenders would provide 100% financing.
Oh, yeah. No, I heard that, like, as in the residential, and they're like, oh, yeah, I want to buy a flip, and I have a lender's going to do 100%. I'm like, really? Who?
Yeah.
I talk to this lender.
I don't know who's out there.
I was like,
but
you mean your mom? Like, I'm sorry, there's no private lenders that are doing 100%.
Yeah.
Yeah.
All right, I'm curious about this one. What is the biggest red flag you see when reviewing a deal?
I think we kind of touched on it a little bit, but I think it probably comes back a little bit more to the borrower and information that either is like not conveyed to us from the get-go or something inconsistent on the loan application that we find out through further due diligence that's contrary to that. Or just like unreasonable assumptions, like I'm going to buy this, multifamily asset. I'm going to renovate, vacate, majority of the units, renovate them and then sell it in 12 months. And it's like, and you don't want a longer loan term? No, we can do this in 12. And sometimes there might be a reason that it's possible, but many times it's kind of the initial, like, they're just not experienced and they are assuming this is just an easy way to make some money and don't have the knowledge.
Yeah. No,
it's not an easy way.
Hell no. I'll tell you that. It ain't easy. Nope.
It may be simple, but it's not easy.
Yeah. Yeah. Thank God for my therapist to help me out. Okay, so what is one lesson that you've learned from a deal that didn't go as planned?
I would say, you just like I think we kind of touched, like, you got to stay calm in the process and just keep pushing forward to figuring out the resolution of the situation. Usually, the situations I'm thinking are the handful specifically that, where we end up kind of in a foreclosure, right? And those are the times. And I think we do look back and go, what did we learn, right, from that? And so I think you just have to kind of work through it and not get too worked up about it, and upset about it. You just kind of go, okay, how are we proceeding forward? And I think, you just have to, you need to do what you need to do. Like if something's just not working, it's like, okay, we just need to like probably control this asset and just, get it on the market and do what we need to do. And so I think it's just a matter of staying calm and working through it and, and keeping your eyes on it and, paying attention because it's not going to go away. It's not going to solve itself. So you just have to be diligent.
No, great advice. So what is a habit or maybe a routine that helps you stay sharp in this high pressure role that you're in?
I think, what I've been doing the past few years that I find helpful, I enjoy going for like a walk, getting outside. I usually put a podcast on or something, like you
Yeah.
said. Like sometimes you're just, when you're listening to a podcast, you're not always in front of your computer, but um, just taking in information of what's happening in the market, or just different. And sometimes it's related to real estate, sometimes it's not even
Yeah.
related to real estate, but just to clear my mind. You get so focused on the things you're doing in that day that sometimes you just need to take that break, get some fresh air, and then come back to it, and things seem easier once
Yeah.
you do that. So I've been trying to do that, and usually it happens towards the end of the day, which makes it difficult when it gets dark at 5:30. But
Oh my gosh, right? Let's get through daylight savings. I'm
Yeah.
ready for summer again.
I know. Yeah.
Ugh.
No, great advice. I could use some of that. What is one piece of advice you would give to an investor that's looking to build a long-term lender relationship with SDC Capital?
I would say, I think honestly, like the two of you have really demonstrated kind of whether you were thinking that you were doing that, or, just kind of the way you approach business in general. But I think one, we're not going to be the right partner or right lender for every borrower situation, right? Like if you're looking for maximum leverage, and there are lenders
Yeah.
sometimes that will go, more on the single family, like 85-90% of value, we're probably just not the right fit. But when you find that lender that has those programs that work for you, I would say regardless, you still always want to have a good first impression. But when you do find that lender that you seem like, oh, I think we could really work with them on multiple transactions. I would just say, yeah, spend the time, kind of educating them on your model, your
Yeah.
approach, your team. You don't, it can just be like site visits and things that happen just in
Yeah.
a normal course of a transaction. But I think you do that when that deal comes that you have to close in 2 weeks, and maybe you've
Yes.
done one deal
Yeah.
together, or maybe you haven't done a deal together, but you've just spoken on the phone. I think that can go a long ways, because now they're ready. I think, we'll already be up to speed, and we'll have some context. And, with that, it's not like this just random inbound call, not that we're not, prioritizing that, but,
Yeah.
we know we need to take time. And if someone has a really fast deadline, we can't always meet that. But I think if you build that relationship, you might also find out through that relationship, you're like, hey, what we're really looking for is a lender who can do X, Y, and Z, and your programs aren't that. Maybe there's a structure that they can provide that they
Oh, yeah.
just don't offer, but it's not that they won't do it. They
Yeah.
just haven't had someone ask. So I
Yeah.
think we're a little unique because we're not institutionally backed, which means that we are investors. We have private investors in our fund, and so we do have obviously our parameters in which we have to lend by, but as long as it meets those parameters, whether it's a credit line or, whatever we structure a loan. I mean, we've done loans with, holdbacks for when a tenant vacates or buys, is bought out versus when renovations are done, or there's a lot of different ways you can structure a loan. So I think if, you might be able to come up with a program that also is good for you and good for the lender. So I think if you have a lender that has, the programs that kind of meet what you need,
Yeah.
spend the time and let them know what you're doing, and,
Yeah.
or even put them on like an email blast, like maybe, if you do the email blasts of things you're doing, like just keep them updated, and there's no downside to
Yeah.
providing that information.
Oh, I need to add you to my
I was gonna say.
newsletter. I do
Shawna.
one every Sunday.
Okay. I think
Yeah.
I heard about that, but yeah,
Yeah.
you should add me.
Yeah.
Yeah.
And if someone wants to get a hold of SDC Capital, how can they do that?
So we have a website.
Okay.
Our website is sdcfinance.com. I'm on LinkedIn. My email address is Shawna, my first name, SHAWNA @sdccap.com. And all of our information is on our website if you want to get a hold of me or anyone else on my team.
Awesome. We will definitely include all that in the episode and the notes. So, Shawna, thank you
Thank
for
you so
joining
much.
us.
Thank you.
Yes.
It's been great. It's been
Yeah.
a great opportunity. I appreciate it.
Yeah.
It's
Yeah.
been fun kind of catching up after a few transactions, and
Yeah.
really excited about what, the two of you have achieved, and we look forward to seeing how we can be a part of it in the future.
Yeah.
Yeah, for sure.
No.
We're taking a break for the moment. I gotta do taxes. I gotta get
Yeah.
out 17 tax returns and all those K1s.
Oh yes.
And
Yeah.
then I'll start underwriting other deals. I was like, no, not
Yeah.
right now.
Yeah. Well, and I think the market is a little slow now anyway,
I
potentially.
don't know. They keep
Okay.
trying
Well,
to push them. They're
Everybody
like,
wants
look
us
at
to buy
this, look
some.
at this,
Okay.
look at this. And I'm like, give me 5 minutes,
Yeah.
please.
yeah, right.
Yeah.
Yeah.
We're
But we will.
stabilizing what we got.
Yeah.
And then,
That's the other thing. Getting
unless
some
something
permits.
really is just a sweet
Unless
deal.
we get another Surfside.
Right. Well,
Yes.
call me.
Yeah.
When I was looking at that deal, I was honestly thinking, gosh, I think, I might want to invest in that. They would
Yeah.
take me, but
Such a
we
good
would
deal.
always take you. You're
Yeah,
more than welcome
okay,
to invest
all right.
anytime.
Yeah, I know.
Yeah.
I was thinking too, like probably
For
down
us.
the road. We'll
I was like,
start
oh, as
investing
we
with
have
you.
cash, we'll just throw that over there.
there we go.
Yeah.
Perfect.
We'll work
yeah.
some now. And I will
Yeah.
definitely, because I talk to investors all the time, and
Yes.
they don't want the long term
Yeah.
game, but
Yeah.
they would be perfect for
Yep.
you. So I haven't even thought of that. Now that you have the fun, especially,
Yeah.
I'll start throwing you anybody that immersible too.
Mhm.
So
Okay.
Yeah. That's why I
Fantastic.
was curious about it. Because
Yeah.
I was like, oh, we might have people that
Oh, yeah.
we can just refer over to you to invest.
Oh,
Yeah.
that'd be great.
Yeah.
Yeah. No, we definitely will. So, but thank you everybody for
Yeah.
tuning in to Ladders and Leverage. Don't forget to hit the subscribe button. We are here for you guys. We just want to provide as much value as possible and share everything that we've learned, ups and downs, and so that you can grow as an investor yourself. So thank you for tuning in, and thanks again, Shawna.
Thank you.